Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Hi, everyone. Welcome to the 33rd episode of Carson's Facts versus Feelings with Ryan and Sonu. I'm Ryan Detrick, the Chief Market Strategist here at the Carson Group. Sonu, your title is?
Vice President, Global Macro Strategist.
There you go. So again, good morning, good afternoon, good evening, depending on when you are listening to this podcast. Sonu and I are really excited. There's a lot of fun stuff to discuss. This is the 33rd episode of our podcast. Remember last week, if you didn't get a chance to listen to it, we had Sam Stovall on from CFRA. Definitely check that out. One of our more downloaded and listened to podcasts ever. Sam's an institution of knowledge, and he also brings a lot of humor to the show. So listen to last week. So Sonu, this week we've titled it, "The Recession is Delayed Again." We keep hearing about this recession. We keep hearing about it. But we're not seeing it, and the data has continued to confirm that. So we're going to really break down the economy in the first part of this discussion. Second part is two of the more popular questions we've received from our more than 350 partners lately. Two things: the debt ceiling, and what's the other thing? Oh, geez, regional banks. Sorry, latest with regional banks and the debt ceiling. So we're going to break those two things down. And depending how much time we have left at the end, we'll take a look at the Fed. Now, Sonu, you have, we'll just tease the crowd. If anybody remembers, when did you last play your guitar? A couple months ago? It was Dire Straits, right?
Yeah, Dire Straits, a little bit of, what? Oh, you know what it was? Pi Day, March 14th. Yep.
Oh, yeah.
That was it.
Yeah, so we have, Sonu's got the guitar, and we're going to end the podcast. If you're listening, maybe just fast forward to the last couple of minutes. You can listen to it if you really wanted to. Then come back and rewind back. Rewind back, but Sonu's got his guitar. Maybe for the people on YouTube, can you show the guitar? Just hold it up. Where is it? Somewhere next to you, right?
Yeah, it's right here. And
there it is.
This is. Yeah. I picked it up from a backpacking trip in Argentina about a little more than a decade ago.
Wow!
So that was like my souvenir. Instead of getting like a little fridge magnet or something, I decided to get a guitar.
So you're not going to go Kurt Cobain and like smash it up at the very end, are you? You're going to keep it in one piece. Oh, good. Well, maybe you help the economy by smashing it up and have to buy a new one.
Buy a new one from America. Yeah, there you go.
There you go. Don't do that. All right. So we're going to jump right in, Sonu. The economy, right? We're going to talk about whatever, among different things. Jobs, light vehicles have been strong. Supply chains improving. Earnings have been strong. Let's start with jobs, though, because you kind of compared the jobs number we saw on Friday to a Goldilocks economy or Goldilocks scenario. First off, what does that mean, and what did the jobs number tell you as to why the economy likely is going to avoid a recession for the near term?
If you remember Goldilocks' story, it's like Goldilocks and the Three Bears. She goes into their house. Mm-hmm. She tries the little bowls of porridge or oatmeal or whatever it is, right? And then one's too hot, one's too cold, and then the third one is just sort of perfect. It's not too hot, not too cold, right? And if you remember before the SVB crisis, and this is sometime in February, everyone was like, oh my God, the economy is too strong. It's overheating. The Fed has got to hike. It's got to hike a lot more. And then the regional bank crisis hit with SVB and Signature. They were taken over and sold and all of that. And everyone was like, it's back to recession, right? We started the year with recession. It's been 4 months, by the way, right? We're a third of the way into the year. And there's, like you said, no sign of a recession yet. But then we get payroll numbers from last Friday, and boom. It's like, yet again, not too hot, not too cold, and hence the Goldilocks theme.
Exactly. So the number in the month of April came in at 253,000 jobs created, expected to be closer to 180. What was interesting, though, was the prior 2 months, which had some huge numbers, and we weren't shocked by this, were revised lower by 149. And is that kind of part of what you're saying? Like, it's not too hot, not too cold. It's solid. We're still making over 200,000 jobs, I believe, the last 3 months. But what does those revisions the previous 2 months tell you?
I mean, one thing is, look, there's always revisions. Revisions tend to happen. It's pretty random, up and down. That's why you usually want to take an average, right? So two things related to this. You take the last 3 months. So forget January was really hot, 470,000 jobs or something like that. But
Yeah.
take February, March, April, you take the average, it's about 222,000 jobs on average per created, right? Per month. That is really strong, right? The average before the pandemic was about, well, let me look at my notes, 183,000. By the way, 183,000 is also very strong, right? If you're above 125, 130,000, I would say that is a really good number, right? So just to keep the 222,000 for the last 3 months in perspective. And then you combine that for January, Ryan, 1.1 million jobs created in 4 months. I think that says it all. The economy is doing fine.
That does say it all. This also jives with what the ADP told us. The private payrolls came out early in the week last week, way stronger than expected again. I mean, so here's the question, and maybe we'll move forward. All we hear about is all these layoffs. The large tech companies, and it's legit, right? And a lot of financial companies are in trouble. There are layoffs, yet the other side of things, then we get this data that says, well, maybe people are getting laid off, but we're still hiring. How do you square that circle?
I mean, I think you just squared it, basically. There's like more than 6 million hires, right? I mean, we got the job opening and labor turnover survey. This was for March. It was in April, but, a lot of people got hired, and between 6 and 7 million people got hired in March. That's a lot of people. A lot of people got laid off, and that's why when you look at the payroll numbers, you're looking at a net number, right? Jobs created minus jobs lost, right? Whether people quit or whether people got laid off or, other discharges, as they call it, right? But speaking of, layoffs, we talked about that tech thing. And now what's the latest thing you hear in tech, Ryan? AI, right? And
yes.
I bet by the end of this year, tech is going to be like, nobody wants to be at the back of the race with respect to AI. I bet all these companies are going to race ahead saying, you know what, we got to catch up. We got to get into this AI game. So I bet, we're not far from hearing the end of tech layoffs. But then you take even manufacturing. Manufacturing, I mean, manufacturing is a bit of a slowdown. I mean, you can argue a recession or not. It's created 11,000 jobs over the first 4 months. I mean, it's not exactly recessionary. Same thing, construction, right? That's added 44,000 jobs this year. I mean, I think the housing downturn is done. And looking ahead, I think housing's going to add to GDP rest of this year.
We talked about that a few weeks ago. Housing makes up about 5% of GDP, but it's a volatile 5%. And it took away from GDP a good deal last year. And you said, hey, we're getting some better news, and maybe it's going to start to improve and help GDP, which I don't hear too many people out there saying. Sonu, one thing I want to point out, so that's kind of where we are with the jobs numbers, employment backdrop still strong. Supply chains, remember this time a year ago, supply chain concerns, all the ships that were backed up all over the place, Port of LA, different places, or Port of Long Beach, I should say. The New York Fed does some monthly data on supply chains, a supply chain pressure index, third lowest ever. They said that European and Taiwan delivery times were cited as some of the major improvements. But the truth is, supply chains are literally no more of an issue. I mean, things are just fine, almost, it appears. And that's one more worry that we had this time a year ago that I just don't see right now. Now, talk to me about light vehicle sales. This is a big one. I mean, you're going to buy a car, or you're going to buy a light vehicle. That's a big purchase. You probably don't do that if you think you're about to lose your job or you think the economy's about to go under. How strong was that last month, Sonu?
That was big. I mean, last month, basically we're talking about April, light vehicle sales increased about 7%, right? It got up to about close to 16 million vehicles. I mean, this is an annualized rate. That's a pace of sales, right? That was the highest since, I'm looking at this, June 2021. So almost 2 years, right? And why have vehicle sales been like rock bottom, basically? Because of supply chain issues. That's slowly coming back, right? It's still not, the good news is it's on an uptrend. The other piece of good news is we still got some ways to go to get back to that pre-pandemic level. Before the pandemic, it was selling about, on an annualized basis, about 17 million vehicles a month. We are at 16 right now, just under that. So I think, we'll get there. Hopefully we'll get there by the end of this year. It's taken, admittedly, I thought it wouldn't take as long as it has so far, but the good news is it's going to be a tailwind.
No, absolutely. I think that's a great point. Again, that's something we're just not hearing as much about. Now, Sonu, I think the final thing we wanted to talk about was earnings. About
Yeah.
85% of companies have reported earnings in the S&P 500. About 79, according to their friends at FactSet, 79% of those have beaten by an average of 7%. That's a really strong number, one of the stronger beats we've seen in a couple of years. At the start of this earnings season, you and I talked about it, let's say 5-6 weeks ago, earnings expected to drop about 6 or 7% for the
Right.
quarter. What's that recent number? It's a lot better, though, than negative 6 or 7, right? Where is it right now?
I think it's down just about 2% year over year earnings. I mean, that's a big beat, right? I mean,
Yeah.
And then you and I were talking about it earlier today, how a lot of companies give forward guidance. What do they think about what's going to happen in the future? And they we all know, they like to play this game where they try to lowball earnings and they come out and beat it, right?
Right.
But it's rare you see a lot of companies giving positive forward guidance. And we've seen more than 50% of companies that have issued forward guidance is saying, things are going to be good. That doesn't happen if you're thinking about running into a recession.
Yeah, I mean, two things we've seen. You mentioned AI. You look at count the words done during these earnings press releases and such. AI has soared, but also, like you said, better earnings expectation. If you look at 2023 earnings, it appears to have troughed. It's actually 1% or so off the lows from just this time a couple of weeks ago. As again, things are not perfect, but wow. Corporate America continues to say the economy is strong, the consumer is strong. Some companies might give a different opinion, yes, but overall, we continue to see people out there spending, and in corporate America, there's little to change that. The big one, Apple, this is not a recommendation on Apple, but again, the largest company in the world, their revenue is almost $95 billion, 51 or so billion, so more than half of that was iPhones. Both those numbers stronger than expected. When the largest company in the world last Thursday came out with some really impressive earnings, that sparked a really solid rally, almost 2% or so on the S&P on Friday. That makes it 2 weeks in a row, everyone, where we've been down on the mat. All right, we've been knocked out by Wednesday, Thursday. Then a late week rally as that S&P continues to flirt with that big 4,200 level. Now, Sonu, 4,200, yeah, it's random by itself, but tell me, where were we 2 years ago on the S&P and 1 year ago on the S&P?
4,200? I mean, I only know it.
Yeah,
I cheated. I saw your chart. That's why I would have guessed that.
Yeah, me either until I saw the chart. But I mean, that how to me it's fascinating. The last 2 years, all the things that's happened. The last 1 year, all things that happened. Yet stocks are flat. And there's, believe me, two ways to look at this. Well, stocks are flat. But man, stocks are flat in the face of, just list some of the things we've seen in the last year. So the incredible things that you think knocked the market down, yet we're flat.
I mean, goodness, you go back 2 years. Okay, we were sort of coming out. This is 2021, right? Yeah, we're in 2023. Sometimes I lose track. But,
I don't know anymore. Yeah.
We were coming out of COVID. I mean, but there was still Delta and Omicron was yet to come and all of that. But still, they're coming out of it. But then, this world's second largest economy wasn't shut down, right, with COVID. If it said that, and then he said,
by the way, that's China. By the way, that's China. China's shut down.
That's China, yes.
Yep.
And then you say, okay, the U.S. is going to experience the highest inflation in 40 plus years, and the Fed is going to respond with the most aggressive rate tightening cycle in 40 plus years, almost Volcker-like, by a Fed chair who sort of fancies himself as the second coming of Volcker, dare I say.
Only shorter. Yeah, Volcker 6'7". Yeah.
There you go. So, but if you said, I mean, I would have said the markets would be a lot lower.
Given
all of that. Yeah.
Absolutely. And I think that's one of the things we've talked a lot about, all that negativity. Last couple of podcasts talked about, put to call ratios and investor sentiment polls and flows and just anecdotal sentiment. You and I get to work with more than 130 of our Carson Partners every day. The majority of the questions we get coming in are not, hey guys, how high do you think this market's going to go? Believe me, those are not the questions we are hearing from clients or from advisors. And from that contrarian point of view, with the economy stronger, maybe that's a positive. I mean, Sonu, anything else on earnings you want to say before we move forward? Or just the economy avoiding a recession in general before we move forward?
I mean, I think this one underlines it. The unemployment rate is down at a 50-plus year low of 3.4%, lowest since 1969, just to give you a hint of what may be coming ahead. But, even with the unemployment rate, you could argue that, okay, the BLS, the Bureau of Labor Statistics, doesn't count participation properly, and there's the effect of demographics, things like that. But then you look at prime age employment population, right? the ratio of people in their prime age working years, 25 to 54, that ratio is at 80.8%, Ryan. It's the highest we got to before the pandemic was 80.5. We are above that. We are at the highest level in 22 years, right? We're getting close to what we saw in the late 90s. And that was like the best labor market the country's, had seen until then in decades. So this is a pretty historic labor market, to be honest.
No, nice job bringing us back to the summer of '69. Hint, hint.
There you go.
Where that might go. Brian Adams, hint, hint. But anyway, yeah, but let's say that one more time. So prime age workers, there's more people working now than pre-pandemic. What's one of the things we've all heard time and time again? Well, nobody wants to work. Nobody wants to work. Yeah. And some of that, but prime age workers are actually working more now than they did pre-pandemic, one of the highest levels in a long time. Again, not something you tend to see in a recession. And that's, again, why we titled this podcast, The Recession is Delayed Again. And that's one thing we're seeing. Now, Sonu, we're going to talk about regional banks and debt ceiling next. But before we get there, Omaha is the center of the financial universe this week. This weekend, Warren Buffett had his annual Berkshire Hathaway convention / festivity / fun party, whatever you want to call it. But later this week, starting really Tuesday, we fly in, but Wednesday and Thursday and Friday, we have the Carson Group Partner Summit, which again is in Omaha, just continuing the party with Omaha. I went to the first Partner Summit, I guess, last September. Never done one in the home region of Omaha. How much fun do you expect to have this week with our partners?
I think that'll be great. For those of you listening, I know a lot of you who listen are advisors, but a lot of you aren't also, and clients too, right? We saw Ryan, about 48,000 households with 350 partners around the country. Just that community coming together is massive.
I'll just jump in real fast. I think we just cracked 22 billion for the first time I've ever seen. Total assets 22 billion. We just cracked that, so all-time high, along with how many families we serve. Go ahead.
And Ron, our founder, likes to say, Omaha is the center of the universe, and I'm in Chicago, Ryan's in Cincinnati, so it's always nice to. By the way, seeing you as well, Ryan. And
it's going to
be nice to get together.
Yes, we can't
for
wait
for everyone to get together. That's great.
Yeah, we can't wait. And again, we will record our next podcast live from Partner Summit. So be sure to follow us on social media, because I think the plan is we're going to broadcast some of these podcasts live, leveraging, I believe it's LinkedIn Live, if that's what it's called, but leveraging LinkedIn. So just, more details to come on that. But we've got some pretty cool things up our sleeve. Carson Group's growing. We're having lots of fun. We love working with our partners every day, helping our partners grow faster on average than your average investor. Average advisor. But if you're an advisor, you're somewhere, you're looking around, you're not really happy with how things are going, go to carsongroup.com and check us out, because the things we're doing here are really special, and we'd love for you to come on, check it out. And this week will be a lot of fun doing that with our current partners. All right, Sonu. So the two questions we've been hearing from our partners more and more. Let's see, it's regional banks. I guess we'll start with regional banks, and then the debt ceiling. Latest with the debt ceiling. By the time most people listen to this, you can go to our blog, carsongroup.com, click on Insights at the top. We'll have had blogs on both these things we're about to talk about. But regional banks, let's start there. We saw a bloodbath in some of the regional banks again last week. Pacific West was the specific one that was down a lot, kind of in the crosshairs. You've done some cool work on your daily note that you send out just to our partners. Talk to me about kind of what we've seen in terms of Fed lending. I think this is really interesting. In terms of Fed lending, what we're seeing there.
So I just, what we saw last week was we had this big sell-off in regional banks. PacWest Bancorp on Thursday fell about more than 50%. Western Alliance fell about 40%. And the regional bank ETF, again, not a recommendation, that fell about 7%, right? It was triggered by PacWest saying, we're seeking a strategic option, possibly, selling part of its business to free up capital, shrinking the balance sheet, and all of that, right? Look, big story is, long story short, there's no real fundamental problem with any of these banks. Unlike SVB had a problem. The way they were doing business, there was a problem there. They had about 90% of their total deposits were uninsured. So when they got into trouble, all those people, there's a WhatsApp group, we talked about it, and all those deposits went away. Whereas with PacWest, Western Alliance, only about 25% of the deposits are uninsured. The rest of it is pretty steady. Those are insured deposits, right? So from a fundamental level, it's very different from those, SVB and Signature and all of that. And look, the best place to look if there was more bank stress or increasing bank stress, are they going to the Fed's, what we call liquidity facilities, to borrow money, right? If they were in trouble, that's where we would go. That's why the Fed,
Right.
Introduced those facilities, right? They introduced this bank term funding program, and that's really the most important one. That's a new facility introduced in March. Banks can take, say they own treasuries, right? And par value is, let's say, 100 cents, right? Or $1. But then because, interest rates went up, bond prices went down, let's say that's worth only 90 cents on the dollar. Now they can go to this facility and exchange it for par. They can tell the Fed, you take this thing, you give me 100 cents back, right? So I mean, there's a cost to it, and they have to pay for it in terms of interest when they, take back the collateral and things like that. But it's, if you're in trouble, that's not a bad deal, right? We're not seeing an increase in usage for that facility. If banks are running into issues with deposit outflows, they could easily go to this facility and exchange collateral at par. But the fact that it's falling shows that things are, pretty much fine within the banking system from a fundamental level, at least right now. I'm not saying, anything could happen, right? But right now, things are okay. The usage of that facility actually fell over the previous week from about 81 billion to about 76 billion. So that's a good sign.
No, absolutely. I believe if you look at the three places, discount window, loans to FDIC
Yes.
banks, and then bank term funding program, BTFP, all three of those combined are a 7-week low, right? Wildly different than what we're hearing. If you look at TV, yes, some of these smaller regional banks have been hit hard. Like you said, Pacific West, I've never heard of them, I'll be honest, but they're based in Beverly Hills. That's probably why I've never heard of them. But again, their core deposits actually increased since March.
Yes.
And believe me, that can change in a hurry. But again, those are some key concepts that, that bank was up a lot on Friday, up a lot on Monday morning as you and I are recording this. Believe me, things can change by the time you listen to this podcast. But those are clearly some signs that we're seeing on the regional bank side of things. And the other big question that we've had, anything else on regional bank? Oh, you know what? I want to ask you, Sonu, you did a pretty cool chart about the feedback loop and how this works. Try to describe this the best we can. This will likely be in a blog by the time someone listens to this on carsongroup.com. Click on Insights at the top and you get to the blog. But it's a feedback loop on how media, social media, some of the things play in. Try to describe this the best you can. I thought it was pretty cool.
I think the analogy I would use is if you think back 2 years back to February, or maybe a little over that, February 2021, you remember that whole GameStop thing? Again, not a recommendation. That whole GameStop thing, things were going vertical up because there was a lot of call option buying. Retail investors are buying calls. So the dealers who were selling them the calls had to hedge for that and buy the stock, and they just kept running up, right? Until fundamentals came back into play, and then things went downhill after that, right? It's literally the opposite of that, right? You get news somewhere that, bank ABC is in trouble. That gets social media attention. There's a lot of put buying. Put buying means you're kind of betting on the stock to fall, right? That's how you make a profit. But on the other side, dealers are basically long the stock, and so they have to hedge for that. And as the stock price goes down, they have to short even more stock. Long story short, pun intended, basically. Long story short.
I like that.
But the stock continues to go down, right? It gets all the social media attention. It gets media coverage as well, that the bank has to come out and say, hey, we are okay. We are pursuing maybe a strategic option, right? Trying to free up some capital. That gets even more media coverage and the stock falls even more. And eventually you get this self-fulfilling prophecy that there may be deposit outflows. Like I said, the good news is a lot of these banks are still fundamentally okay with respect to how they do business. But eventually the idea, or for people doing this, in this feedback loop, the idea is maybe the FDIC takes over, sells a bank at a big discount, equity shareholders get wiped out. They make a profit, right? There's nothing wrong in short selling. I do want to say that. Nothing wrong with it. It's just that we are in this feedback loop of social media and short selling and speculative attacks on, some of these banks. So that's where we are at. Like I said, there's nothing fundamentally wrong with a lot of these banks.
Great points there. And we'll move forward, but that's definitely an interesting way to look at it. So the debt ceiling, we're going to hear a lot more about this over the coming weeks as concerns. We've got $31.4 trillion is how our country pays the bills. And, well, we're running out of time. It's called X date, when the country literally runs out of money to pay a lot of the bills. No one knows exactly when that is, but it's sometime in June in all likelihood. Janet Yellen is in charge of the Treasury. She said June 1st or so is when that's going to be. What worries, I guess you could say most investors that remember some of these times is 2011, right? We've increased the debt ceiling, so 89 times since 1959, more than 100 times since the first time ever, 1917, to finance World War I. Yet it's a scary time, as Sam Stovall mentioned last week on the podcast. The media's job is to kind of click onto those or hitch onto those scary times. That's when we really remember. I remember August 2011 when we had a debt debt ceiling issue. S&P came out and somewhat unexpectedly, apparently, because the market sold off 19.4% in about 4 or 5 days, almost a bear market in about a week, on the U.S. debt downgrade. Do you think we're going to see, first off, another U.S. debt downgrade? Do you think we're going to kick the can? What's your take on exactly how this all could play out? And again, we're probably at least a month away, but how this could play out.
I mean, never say never, right? But I look, like you said, what we've raised the debt ceiling 89 times. I dare say we're going to be seeing it being raised a 90th time. But here's something interesting. I saw this from your blog on the debt ceiling, by the way. But everyone should check it out. It's on the carsongroup.com website. It'll be out by the time you're listening to this podcast. It's right now in the compliance journal. One thing I didn't know is that the U.S. is the only country other than Denmark to do it this way. Right?
Yes. And I'm not sure why. I don't know. Most countries just do their debt ceiling based on a percent of GDP. We like to do it nominally. We like to vote on it every so often. I don't know. I said maybe we just like drama in this country, and Washington can kind of point fingers, and then when it's all said and done, there we go. We're the winners or we're the losers. I don't know why. I don't know. Us in Denmark. It's a Jeopardy question. There you go. The other thing about this interesting. Oh, go ahead, Sonu.
No, I think you were probably going there as well. I mean, you'd have to look at two big players. But these things, you think, I mean, there should be a deal. I think one problem right now is we don't see the pathway to a deal, right? Nobody sees, what is a path to a deal? It seems like the parties are really far apart, and they are, right? But I was looking at this, what we call a SWOT analysis of, President Biden and McCarthy. What are their strengths, weaknesses, opportunities, and threats, right? And this is on our Twitter feeds. You can take a look at it. And it'll be on the blog by the time you listen to this podcast as well. But the idea is there's a lot of opportunity here, right? At the end of the day, what's President Biden's interest? Winning re-election next year. What needs to happen for that, or what needs not to happen? The economy going into a recession, especially a self-inflicted one, right? Speaker McCarthy, he wants to stay in power too, right? He wants, and for him to stay in power, Republicans need to hold the House, right? I mean, the economy going into a recession because of, like I said, a self-inflicted goal is not in anyone's interest here. So there's a lot of opportunity for dealing, I think. It's just that everyone's going to be in that corner right till the very end. And that's going to be painful for those of us who follow markets and the economy.
Yeah, and remember Libby Cantrell joined this podcast several months ago. We've got her back on from PIMCO, their political strategist. I'm sure she's got a different title, but this is her world. She's going to join us in a couple weeks when this is really probably starting to heat up and break things down. Now, if you look at those 89 times since 1959, Sonu, that the debt ceiling's been increased, 56 of those times took place when the Democrats were fully in charge of Congress. 9 times when Republicans are fully in charge of Congress. Now, take note, Democrats have been in charge of Congress much more than any other scenario going back to 1959. So it makes sense they've had the most increases. But the one I want to point out, 24 times when you had a split Congress, you had both parties work together to increase the debt ceiling. So just the makeup of Congress by itself doesn't appear to be any major reason not to think that we cannot kick the can one more time and increase the debt ceiling. Now, so we've gone a long time. We've got a couple minutes here. The Fed was one of the big events last week. The Fed did increase interest rates once again. The upper limit on the Fed funds rate now is 5.25, up 500 basis points. They've done 10 consecutive interest rate hikes. I guess my question to you is, do you think this was the last one? A lot of people say that, but we've heard that for a little bit too. What's your take on that?
I'd like to think so, especially conditioned on the fact that we don't get another massive inflation surprise. I mean, we may get month-to-month noise, but that's all I think it is. It's like a little noise. I mean, 1 month airfares may go up, but that may be offset by car prices, or car prices may go up. Something will be offset by something else. But we know the general trajectory, I think, goodness, you and I have talked about it for a long time. That trajectory is down, especially as shelter inflation comes down, right? So I think barring a massive inflation surprise, which will probably more often than not, these surprises come with some big spike in energy prices, right? And food prices. Thankfully, energy prices have been really stable. Utility prices, actually, the good news for people's wallets at home is that natural gas prices are down, so utility bills are trending down as well. So that's good. Food prices are coming down. We talked about eggs and strawberries and whatnot, right? So that's all good news with respect to people having a little more money in their pockets than they did last year this time. So I think the Fed's done. But that doesn't mean they'll cut.
Right. That's the next thing. A little bit on that. The Taylor Swift indicator we've talked before. There's no way you can have a recession with Taylor Swift going out and doing what she's doing. And I bought, as I talked about this podcast, I think it was back in December when I bought 6 tickets. We're looking to sell a few of them. I'll tell you, there's inflation there, Sonu. These tickets are going for crazy prices, which I'm like, hey, if I can actually make my money back, spend a lot of money on these 6 tickets, I get my money back on that. But a few things also from Powell last week. Really no major comments at regional banks, which is a tad surprising. He said still doesn't see a recession, modest growth. He said banking system is quote unquote sound and resilient. They did, let's see here, where is it? Some quote unquote, some additional policy firming may be appropriate was taken out. So all in all, he set the stage, maybe a better way to put it, for this to be the last hike. Of course, data dependent. They're going to watch everything. But by the time a lot of people listen to this, CPI might have come out. So we'll get a little more information on inflation in general. But I guess the other thing, Sonu, was the prepared statement came off dovish, market rallied. But then during the Q&A, he came off what was apparently a little more hawkish. Markets sold off. But by Friday, it seemed like people kind of took a look after they slept on a little bit. Said, maybe he wasn't as hawkish as we thought. Believe me, it's confusing. I still think it's the last hike likely, as long as inflation doesn't soar, which we don't anticipate. If it is the last hike, what does that really mean for investors, you think, though?
I think the key difference between what's happening in markets right now, what Powell said, and I think Fed officials generally. Look, I'll put it this way. By the end of this year, I think you and I probably maybe on the same page that it's not like inflation is going to be close to 2%, which is the target. It'll probably be about somewhere between 3, 4. I think it'll be trending down. I think we'll get below 3 next year sometime, barring any surprise. So which means what? If inflation by the end of this year is somewhere between 3 to 4, let's say 3.5%, they're not going to cut rates. Whereas the market is pricing in at least 3 rate cuts by December, starting in September. So I think what's happening in markets is they're pricing in a crisis, some sort of recession or something like that to start. And every day that we don't get one, the odds of that reduces, by the way. It goes back to the title of this, right? Recession is delayed. Again, right? Each and every day we get good news. We get another day without crisis, another day without a bank shutdown, another day with better payrolls, slightly better inflation numbers. That just pushes out things further and further out, right? So, including rate cuts.
Yeah, exactly. Like you said, the market's anticipating, if you look at Fed funds futures, 3 rate cuts later this year. We don't see that happening. We'll continue to talk about it. I know Sam Stovall last week didn't see it happening as well. So everyone, thank you again for joining the 33rd episode of Carson's Facts versus Feelings with Ryan and Sonu. And again, we titled it, where is it? There it is. The recession is delayed again. Now, the reason everyone is here, Sonu, after that start.
Oh, right.
May of 1969 was the last time the unemployment rate was this low. Also a famous time for the famous Canadian singer Bryan Adams, Summer of 69. Sonu's going to end this podcast strumming a little bit from the Summer of 69. Take it away, Sonu.
All right. shortened it a
Yeah.
little bit, but hopefully
Let's,
it sounded all right.
That was awesome. Let's see AI take that away. AI might
All
take some
right.
things
Yeah,
and
there you
come up.
go.
AI can't do that. Take that. That was
Okay.
awesome. That's real quickly, Sonu. Where's that guitar from? I know we talked about it earlier. Where's your guitar from? What's special about it?
Patagonia, down in Argentina. I was backpacking, and this was my souvenir. This is my fridge magnet, so to speak.
How do you get one of those back through custom? Custom's always so picky. Were they picky back then, or I mean,
No,
I don't know.
They were.
Yeah.
They were all right. It was a big piece.
Good.
It was more the airline. Where do I store it?
Oh,
that was
point.
a problem.
That's a good point. So, that was awesome, Sonu, as always. Everyone, hopefully you enjoyed the 33rd episode of Carson's Facts versus Feelings with Ryan and Sonu. A lot of fun. And again, definitely listen this week. Follow us on social media where we'll be sharing some live links to the latest podcast that we're going to do. There should be a lot of fun in Omaha this week. Like we said, Omaha is the center of the financial universe this week between Warren Buffett's annual meeting and then our I guess it's biannual partner summit with more than partner summit with more than 350 of our partners. Should be a lot of fun. So everyone, we'll see you then. Sonu, I'll see you in person, I guess tomorrow night, maybe, or at least Wednesday morning. One or the other. We'll see. Definitely Wednesday for sure. There we go. Right. Take care, everyone. Bye-bye. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.